Tesla has crushed earnings. Excitement level is all-time high, Paul. They're doing wonderful things. We love them. Why is their stock down?
So first off, my Tesla's on order. It is now coming in July. I'm pretty excited about it.
What color?
White.
Go on.
Of course. You have your Tesla. Mo got his Tesla in February or March. He loves it. The car is phenomenal. Elon Musk is a brilliant, brilliant man. And so now it's time to look at the numbers and understand what is going on with Tesla stock.
So, Paul, they're building Tesla Shanghai. They're building Tesla Berlin. What does this lead to in their financials?
All right. So let's go to the 8 pillars software. Let's pull up Tesla. Okay. So first off, this car company, I mean, look at this chart from the last 10 years, Seth.
Yeah.
I mean, this stock price has just been gangbusters.
One of the best investments around.
Oh, absolutely. And in the last year, high of 1240, and now it's at 864, a little bit down today. So guys, this is an $875 billion company. Our 8 pillars will tell a story. So guys, pillar number 1, we want the 5-year PE for the company to be under 22.5. It is 1,824, massive X. Now, usually I would sit there and say, okay, well, we can always grow into that value, but 1,824 is a big, big number. But our job is to look to see if the growth potential is there to justify that. Because if it's very, very low earnings and they're in the beginning of a very big growth of earnings, it could be okay. So just hang with me tight right there. Pillar number 2, the 5-year return on invested capital, we want over 9%. It is 2.9. But again, guys, I look at Tesla and go, yeah, but it's a growing company. They're not going to have a lot of free cash flow as they build out factories, which they've been doing and all these things. So the free cash flow is going to be lower. So keep that in mind with this company. That story is different as they are growing. Pillar number 3, we want revenue growth over the last 5 years. So we go to our income statement on our software. We go 5 years ago, 11.76. Last year, 53.8. Massive check mark, almost 5 times more. What could you ask for? What more could you ask for? Pillar number 4, we want net income or profit growth to be positive over the last 5 years. So we scroll down just a smidge. They lost almost $2 billion 5 years ago. Last year when they made $5.5 billion. Massive check mark there. A $7.5 billion swing. Seth, is this telling all the great story?
A lot of people are saying that they're now in the clear. They've overcome a lot of the bumps. You know, there's old interviews where Elon was saying that this company was weeks from going under. There's a lot of positivity around the fact that they've cleared all this.
They're a major player in the car business.
I see more and more every day. I see
every
driving
single
down.
day.
I used to be one of the loners driving down the road.
I know. Isn't it incredible?
You used to wave to each other. Now it's just commonplace.
I was just like, what are you doing over here?
Yeah. Keep going.
You have the 2013 loser. So pillar number 5, guys, and this is where I think the first hurdle comes in for Tesla. Shares outstanding. Now, when a company has shares, when you buy into a company and it has 10 shares and you own one of them, you own 10% of the business. But if they issue 2 more shares to bring other investors in, it might sound great, but it's actually not great for you. You still own 1 share, but now instead of splitting the profit and revenue up amongst 10 shares, you're splitting amongst 12 shares now. So instead of getting 10% of the revenue and profit, you're now getting 8.33%. It's called dilution, and it's a silent killer. So let's draw on the bottom of the income statement. The end of 6 years ago, they had 720 million shares outstanding. Now they have 986 million shares outstanding. That is dilution of 30 or 40%.
Now, not to be confused, is they've split down a few times, and
that's not the same thing.
They're going to split
Great
more,
point.
Paul. Yeah, they're going to split more this year.
Yep, that's not the same thing. That is merely diluting shares. When they split, that gets adjusted for the split going all the way back. So that's an X right now and kind of a concern for me. Pillar number 6.
I would imagine they have a ton of debt growing all these new car lines and
well,
factories.
They're issuing shares, though. I'm sure they're using that money to do that with.
Go on.
So that's the benefit of issuing shares when you're an expensive company. Go issue them, give them to everybody. It doesn't take on debt for the company. 6th pillar is we want to look at their long-term liabilities relative to their 5-year free cash flow. So we go back to the main page. Their 5-year average free cash flow is $1.17 billion. Now keep in mind, look at last year's free cash flow, $7 billion. So 1.17, we want to multiply that by 5. That's $5.6 billion. We want their long-term liabilities under 5.6. Again, this is going to be skewed because the last 5 years free cash flow has been very, very low. But we go to the balance sheet. Let's scroll at the bottom, $11.4 billion. So way too high. But last year's free cash flow was almost $7 billion. Mm-hmm. That makes the story a lot better. If they can keep that going and increase it, this debt is nothing. It's not a big deal at all. So it's only skewed because 5 years, the last 5 years, they spent a lot of money on capital expenditures, building factories. So guys, pillars number 7 and 8 have to do with free cash flow. So we go to the very top. We go to the cash flow section of our website. We scroll a little bit. Free cash flow is the lifeblood of the business. It's cash from operations less your capital expenditures. I've added this line to make the math easy for you, so you don't have to do the math yourself. 5 years ago, they had a negative $4.4 billion in free cash flow. In the last 12 months, they've had $7 billion. That's a swing of $12 billion. That's incredible money, okay? Our final metric, so that's a check mark. Our final 8th pillar, we take the 5-year average free cash flow. And remember, it's going to be low. We multiply by 20 for some sort of valuation metric. I'm even laughing at this. $22 billion. Like, that's just a joke. $22 billion. Got it. It's an X. But you've heard all this. The 8 pillars. We're going to do the math for you. The 8 pillars tab right here does all that math for you. So that's why you don't have to waste your time with it, because I don't like doing it either. But you see there's a lot of X's here. And these things are high. But I want to make sure that we're understanding the fact that Tesla is a growing company and you should pay more for growth. The question becomes, how much is too much for growth? So that's why we're going to use a stock analyzer tool next, right? Because the one thing that everybody says is growth, 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 right? Even Elon Musk said, I think 50% growth is in our viewpoint for this year and next. Let's go to the stock analyzer tool.
This has to be, Paul, one of the most exciting companies to ever be around. I feel like I've talked about before, little kids love the car, old folks love the car. It's so they have no commercials, yet everyone knows who they are, and their superstar Elon Musk making all these new moves with Twitter and SpaceX. It's like
awesome.
Unstoppable. So all this is wonderful, Paul. How do our viewers translate this into a price to pay for this company in terms of a stock?
Well, let's go to our stock analyzer tool. So I do believe that Tesla is out of the woodwork in terms of staying around. So I think it'll be around for 10 years and a much bigger company 10 years from now than today. So the question is, what's the revenue growth? The very first line of our stock analyzer tool, because what we do here is every investment's the present value of all future cash flow. We use a stock analyzer tool to basically do that for us. Tell us what our assumptions are. We're going to put assumptions in. It's going to tell us what those assumptions are worth today. Revenue growth. It's already doing $50+ billion in revenue. So if it becomes the number one car manufacturer in the world, let's say that, then I'm going to sit there and say that'd be $500 billion. That's 10 to 1 over the next 10 years, right? So 10 to the 0.1, that's growth of 25% a year. So I'm going to start with 20, 25, and I'll put in 30.
Okay.
It's a very high number.
Yes.
And again, guys, this assumes that 10 years from now, Tesla is the number one car manufacturer in the world. Profit margin. Now, the last year they've had a really high profit margin, but even Elon Musk has said, hang on a second, we had to increase our prices a lot because we see future costs being higher. It'll be weighed down then. So I'm still going to keep this. I'm going to go a little bit lower. I'm going to keep the 10% profit margin in. And then I'm going to say, you know what? They're going to figure out a way to make better margin on their cars, which has yet to be seen, but it's fine. Free cash flow, I'm going to keep the exact same numbers in. And then PE. Guys, even though it's a high PE company, I still... when it's the biggest company in the world, with it's the biggest car manufacturer in the world, PE is determined based on growth potential. When it's the biggest car manufacturer in the world, how much more growth potential does it actually have? This is where we get a lot of feedback here, and I get it. But remember, it's all great and dandy. If you think 70 PE for this company 10 years from now, like other YouTube idiots, is okay, guys, it's just not going to happen. Maybe 5 years ago, 10 years ago, when it had a lot of potential, but when it's the number one car manufacturer in the world, the growth potential isn't there. You should pay a higher PE for more growth potential, not for less growth potential. So I'm going to go 14, I'm going to go 18, and I'm going to go 22. I don't believe the 22 number, but I'll still keep it in there. And I'll do the same thing for free cash flow. And finally, guys, our annual return, our desired annual return, I always do 12.5%. Because you can do an ETF for 9 or 10%. So give yourself some margin of safety and give yourself a reason to actually buy the stock individually. Hit the analyze button. Guys, it's just looking like it's a little overpriced. And this assumes no dilution also.
Yeah.
Which they've already diluted 25% in the last 5 years. So right now we have a low price of about 138, a high price of 730, and a mid price of 350.
Are you willing to bend your rules for a company of this magnitude?
I bent the rules by making these assumptions.
I see.
Remember, I bend rules when there's a justification. Tesla is growing like crazy. I went and put in growth rates that I don't usually put in. I don't believe this growth rate is really realistic. Remember, guys, we don't know what's going to happen a year from now. To go 10 years and say they're going to have 25% revenue growth, is it possible? Absolutely. Is it probable? I don't know. Just look at the last year, look at the last 2 years, all the things that have happened that we didn't think would happen. Look at the last 10 years.
Yes.
In the last 10 years, what has happened in this world that we didn't think were going to happen? We have mortgage rates now at 5%, when a year and a half ago, they were 3%.
That's right.
Who would have guessed they'd be up 66% in 1 year? We just don't know.
So this is really monitoring your downside risk. If you and your friends keep talking about Tesla and how wonderful everything's going to be in the future, if it's not, this company could easily fall 40% in one night like Netflix, Paul. Wouldn't you agree?
It could. I don't know what's going to happen. All I know is that when they were at $12.40 a share and their stocks and now they're at $8.50, but yet they just reported record earnings and they were down 12%. It tells me that maybe the buying of Tesla has been exhausted. Everybody's going to own Tesla, owns Tesla now. So what's the upside? But remember, to beat the market, to do what everybody else is not doing. When I go play Firestone Country Club in Akron, Ohio, and my 18-year-old caddy tells me I'm wrong on Tesla, that's a concern. That's my concern. Like, if everybody's buying Tesla, it's been bought. And I get worried about that. My personal opinion is I'm somewhere probably closer to the 140, 150 mark because I believe in devout value investing. Monish Pabrai, he doesn't agree with me. Mm-hmm. He thinks Tesla has more upside potential, and he's a great value investor. I'm somewhere closer to this number. Sound like a big drop? Would you have thought Tesla would drop 30, 35% in the last month and a half when they had record earnings and record revenue in this bad supply chain environment? You'd have thought, oh my God, this thing's going to the moon. And it didn't. So I just say exhibit some caution and go from there. Right now, I'm just holding off on Tesla.